You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mikey Hu. Hey, what's up, Market Moose? Mike from The Moose on the Loose. Hope you're doing well on this Thursday morning. I'm going back on a question I receive a lot. The more I talk about my portfolio, the more I'm being transparent, the more people ask me, in what would you invest right now? And the premise is kind of like the same thing all over again. The market is trading at a all-time high. Most of the stocks are overvalued. So it's great that you invested in 2017, but fast forward today in 2024, would you invest in the same stocks? Actually, they're not even asking me if I would invest in the same stocks. They're literally telling me, well, in which kind of stock would you invest now? Like, kind of thinking that I would not invest in what's in my portfolio, which is kind of strange to me, to be honest. I'm not sure I understand the question fully for that reason. Maybe it's because a lot of investors think that the right time to buy was before, but not today, right? Before being like behind yesterday, and today being like whatever days that you're listening to this podcast. Actually, even if you listen to it in 10 years from now, here's an example. A lot of investors would say, "Oh, the right time to buy National Bank is over a few years ago when it was trading around $100," and that opportunity happened a few times between 22 and 24. But now that it trades above 125, well, the easy money's gone and there's no point of buying National Bank right now. It's trading at a all-time high. It's overvalued. And the question is coming back again today, would I invest in the same stock? So all that thought for a second about National Bank, but we're going to go on like a broader answer at this point. First, the short answer is yes. I would exactly invest in what's inside my portfolio. So if you're looking for like stocks that you want to do some research, some stock ideas that I find interesting now, well, they are in my portfolio. Most of them, actually. And I'll tell you why now. Back in 2017, when I invested my pension account, we were in a similar economic environment in the sense that we were in a bull market that was almost uninterrupted since 2009. If you ask anybody, any financial analyst, read the media, most people will tell you that the stock market was highly overvalued in 2017. Like there was no good place to put your money in because the stock market, the stock price were going up year after year after year after year. We were just long time due for a correction. So what I did back then is I actually invested all my money because my key point in my investing strategy is to find about quality companies that have a robust balance sheet and shows strong financial metrics for the past 5 years, notably the dividend triangle, so the combination of revenue, earnings per share, and dividend growth, and finding the narrative that will explain that this company will continue to thrive moving forward. So already starting the research with a strong stock screener, looking for robust dividend triangles or company that has been thriving, like not stock price, just fundamentals like financial metrics going up for the past 5 years, and then trying to understand the narrative of what happened over the past 5 years and see if this story is still true moving forward. And in the end, the reason why a stock price goes up, I mean, there are kind of like two reasons, right? The first one is the hype. When investors expect the company to generate more money. So more sales, more profit, more cash flow, more of everything. So when there's that hype, like right now we have like AI, so all companies related to artificial intelligence. A lot of investors are thinking, oh, they're going to make so much more money in the future, I'm going to buy right now. So that's one reason that would explain why the price goes up, is investors are rushing to buy the stock now. Another reason, again, it's still offer and like demand and supply. So if there's a lot of investors that wants a stock, the stock price will go up. If nobody wants to buy the stock, well, of course it's going to go down, right? So the other reason why a stock price will go up over a long period of time is if the business makes more money. So if there's more earnings, more cash flow, of course the stock price will go up. But in the end, when you're looking at those metrics, maybe you're going to realize that you're not paying more today than you would have paid 5-10 years ago. And here's my example with National Bank, like circling back to my question earlier. So would you have loved to buy National Bank at $44 in 2016, like almost 10 years ago? That would have been amazing, right? $44. You would have tripled your money plus the dividend over the past 8 years. I mean, if you offer me that opportunity right now to go back in time and buy National Bank at $44 in 2016, I would jump on it, right? Literally. Well, do you know what the PE ratio was in 2016? Ironically, it was around 13. So 13 times the earnings, that was the price to pay for a National Bank share. So was it expensive? Well, fast forward today, it was super cheap, right? Because you bought something at $44, now it's trading almost at $130. Plus the dividend during this entire time, like the total return on this is just amazing. Okay, so what's National Bank's price today? Like a little bit over 125, right? What's its PE ratio? Well, it's actually 12.5. Yeah, let that sink in. So in 2016, it was a deal to buy National Bank at $44 because now in insight, we know that the stock price went up, right? But the valuation was 13 times the earnings. And today we're pretty much at the same level, like around 13 times the earnings. Why is it more expensive today than it was in 2016? I mean, you tell me, because right now it's the same valuation metric that we use, and we get the same value. So in the end, that's why I would invest in the same stocks today. And here's the thing. I regularly look at my portfolio. So I review my portfolio quarterly, looking at the results, mostly focusing on financial metrics, not the stock price, so not the year to date or stuff like that. For me, the stock movement is completely irrelevant. What I want is to make sure that the financial metrics are aligned and that are supported by a strong narrative, a strong investment thesis. So the reason why I sold Magna International this year and I sold Enbridge last year was because my investment thesis was not aligned with the company's dividend triangle anymore. And for that reason, I was like, you know what? I made profit on both. Actually, Enbridge was a pretty good investment. I made like more than 50% profit on this one, counting the dividend plus the capital appreciation. And yet, they are not in my portfolio anymore today because today I would not invest in those companies. So I invested it back then, like several years ago, for specific reasons. But at one point, those reasons or the environment has changed and I decided just to let it go and move on. So I would replicate the exact same portfolio if I would wake up tomorrow morning and I would have another pension account to invest. I would just copy paste my portfolio and just reinvest. The only different thing I would do if I had a lump sum of money now is I would try to equal weight all my position exactly the same way I did in 2017. So right now, if I look at my pension account, and you can go on the dividendguyblog.com and look at it, you'll see all my positions, Canadian and US stocks, everything is there updated monthly. So my smallest position right now is Toromont Industries at 2.2% of that portfolio, and my largest positions are Microsoft and Brookfield at 9%. So my target would be more like 3 to 4%, having about 20 stocks in that portfolio. So try to equal weight everything. I don't do it now because I like, number one, I like to let my winners run. So when a company goes up, well, I just let it continue to go up, right? That totally makes sense to me. And the other reason is trying to maintain an equally weight portfolio would end up into so many trades, so much time consuming, and so much fees. for a lot of us. Like, I'm with National Bank Direct Brokerage, so I don't have to pay any fees there. But still, it's a very time consuming, and I just like when I see my winners going up. So those are the reason why I do not have an equally weighted portfolio today, but that would be the only difference. If you are curious about my investing strategy and how I see the market and how I build my portfolio and I intend to manage it going forward, you can download the Dividend Income for Life guide that explains all my strategy, that provides you how to build your portfolio and shows you some stock ideas at the same time. So you can go on moosemarkets.com/income. So that moosemarkets.com/income. I explain my methodology, why I invest this way, a portfolio building example, plus the cash reserve if you are retired. So a withdrawal strategy. Again, moosemarkets.com/income. And this guide was created last year. I am working on a major update for this guide that will be sent to my DSR members, but I will have the guide for free sent to all my my readers on my newsletter. So the best way to get the updated version of that guide in about 2-3 weeks will be to sign up at moosemarkets.com/income. All right, Moose, I hope that you have enjoyed this show, and tomorrow we are back with a Business Friday episode. In the meantime, don't forget to stay invested. Hey, welcome to the disclaimer. If you're listening to the Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy this show and do your due diligence after it.